how passionate you are about people actually deploying capital as opposed to putting it on a balance sheet, which makes a lot of sense, obviously, given your background. But that is not what I typically hear. I typically hear, I don't know, share buybacks are bad, share buybacks are value destructive. And clearly, I mean, just to stop right here for a second, anytime you're deploying capital, whether to an acquisition or anything, there is the chance that you may miss the mark. That is all over the place, but that is not at all specific to share buybacks. So I'd love it if you could just expand on your thinking there, just kind of help everyone understand why that is not a bad way to deploy capital. Dispel that idea.
Sure. This is a little bit more of an open-ended question around balance sheet management and capital deployment. Private equity will teach you, and this is what Steve Schwartzman was one of the most famous for doing, is you don't want any cash on a company's balance sheet. You want as little as humanly possible. Cash is super expensive. It gets inflated away. You want debt. You want to lever it up. You want to give yourself an opportunity to increase your return on equity. So in the private equity world, where they're allergic to cash, they want no cash, they want as much debt as possible and the minimum amount of cash that it just takes to keep the lights on at the business, because the more debt you have, the more you're increasing the return on equity for the business. How a business deploys any excess cash to its shareholders is a very difficult decision. And dividends is one of the most inefficient things in the world because you have to pay income taxes on it right away. And shareholder buybacks, the challenge with shareholder buybacks is companies have turned them on as programs as if they were dividends. And that is dumb because share prices move all over the place. And the best companies are very tactical as to when they're actually, so again, to use, our lovely famous Warren Buffett, he almost to a T, once his shares started trading below about 1.2 times book value, that was when he started the share repurchase game, which for the first time revealed how much Warren thinks his business is actually worth. And, this past year, it was down to almost like 1.1 or 1.15 times book value. And that was when you saw the biggest purchase ever. So there's a whole bunch of benefits as to why share repurchase is good. Number one, it benefits all shareholders equally. You're not, sending capital to a preferred stockholder necessarily. You're shrinking the capital stock and you're doing the opposite of dilution. For every startup in the world that is so panicked about having to dilute their company as they're raising capital, you understand a share buyback is the opposite of that. It's a really good thing for everyone that continues to own the company. The second thing is obviously the tax treatment piece of it, because he's giving you value. Or not the board of directors in authorizing the repurchase and then purchasing it at a price that is below whatever the intrinsic value of the company is, which is difficult to measure. But if you're running the company for long enough, you start to develop a good feel for what the intrinsic value of your business is. And so long as you're doing it below intrinsic value, you're delivering actual value to all shareholders in an equivalent manner all at the same time. REITs, actually, real estate investment trusts, are a really simple demonstration of this because they own property. There's a lot of income tax rules where they have to deliver 90% of what they make to shareholders. Otherwise, they don't get this beautiful REIT status of not being taxed at the corporate entity. And what REITs do is the REITs have book value. And if that book value, if they are trading at a premium to their book value, they're like, whoa, cool. Let's issue more shares. We're trading at a premium to book value. And then let's go buy more buildings. Because what they're doing is that's a very low-cost way of getting capital because they're able to get capital for more than what their buildings are worth. And if the opposite happens, and you saw a good amount of this during the last year with the pandemic hitting and people afraid that no one's going to go into an office ever again. And for the first time, you started to see some commercial office REITs trade at a discount to their book value, which meant that's the public market saying your buildings are worth less than your balance sheet says they're worth. And the REITs are saying, well, this is the greatest thing in the world because now we don't have to go and buy new buildings anymore. We can just buy our own stock back because we're buying buildings at 20% off. So I think the real estate example helps frame it in a very tangible way. But then you take that and apply that to, how a company with, operating earnings, they have the opportunity to do exactly the same thing.